gave up managing billions to become a better investor. Episode 17. When do you get smarter about investment? Hello. In the previous podcast, I talked about central banks and interest rates and inflation and some thoughts about all of those changes and shifts. To be pleased, I'm not going to talk about that again this time, although I will very, very briefly announce that I came across a most interesting insight the other day, which was that for the first time in just over a year, the cost of an English breakfast is apparently starting to go down, which doesn't surprise me as particularly strange, mainly because, of course, consumers are spending less, companies are realizing that, or areas, sectors are realizing that, and consequently prices are starting to fall. And this is how the law of supply and demand, I guess, ultimately works. So we shall see whether I'm correct or not for criticising the Bank of England last Thursday and raising interest rates by 50 basis points, 0.5%. But I feel as if it wasn't a wise thing to do. I think the Bank of England should have held interest rates and should have frankly continued to have done that over the balance of the rest of 2023. We'll see whether that's a wise call or not over upcoming months and so. What I wanted to talk briefly about today was becoming a smart investor, really. And we've talked about the subject a few times before on previous podcasts, which really ultimately comes down to the notion that apart from working hard and doing research and all of that sort of thing, which anybody who isn't a technical investor, and if you're a technical investor, believe me, I guess this isn't relevant for you, and I guess this podcast is not really your sort of bag in any case. But if you're more of a sort of a fundamental investor, a sort of an investor who likes to research and think things through, sort of combine macro and micro kind of insights, sector stock matters, put it all together and try and work out whether an investment choice, irrespective of what sector or investment area it's in, is relevant, how it fits into your portfolio or not. What I kind of feel is super important is the fact that you've got to accept that sometimes you're going to make a mistake. And until you make that shift, as soon as you start acknowledging that, you're going to always struggle to become a good investor, or at least an investor which justifies doing it rather than buying a passive fund or keeping it in the corporate pension fund or whatever other sort of alternative may out there, third-party alternative that may lay out there for you. And it's kind of interesting, isn't it? Because sometimes people have said to me, well, it's easy, isn't it? You know, you learn from your mistakes. We get that. You're going to get smarter as you get older. And yeah, there's some truth in that, but it's not a perfect kind of linkage, really. I've seen some smart investors in their relatively youthful years who actually have learned already that sometimes they make mistakes, they accept that, but they're keeping on learning, they're keeping on pushing themselves, they're trying to make all the right efforts, working hard to try to make decisions and allocation choices in their personal investment portfolios, and are cracking on in a very positive fashion. And of course, by contrast, I've seen the complete alternative for people who frankly should have learnt by now that maybe it's better to be allocating their monies to passive or third-party investment choices. But there you go. That's, I guess, is the excitement about life, isn't it? Things are not easy and never are. But if you work hard and actually keep on improving, you can make a change at any point of your life. That's the nice thing about it. I guess the other aspect we wanted just to briefly sort of think about was the relevance of age per se, because there is a relevance, because sadly, we're all not going to live forever. Sadly, you know, I'm afraid that's reality. And as an investor, you've got to think a little bit about that, mainly because as you reach a certain age, maybe you wish to run a slightly different style of portfolio. Maybe you've got different requirements. And of course, inevitably, at some point, we'll all be looking to sort of evolve into a pension scheme or something like that. How does that kick into being an investor? How does that sort of impact what you're thinking and doing? And it's a valid subject. It's something which we all have to think about at some point. As I've talked about before in previous podcasts, I see that I do criticize the kind of the very typical 60-40 portfolio, 60% equity, 40% bond, or 50-50 portfolio, or various other iterations of that structure, which inevitably focus on more and more bonds as you get older. And you've heard my criticism about too many corporate pension schemes with 90% allocation to bonds, which just seems somewhat strange to me at this moment in time, but we shall see on that front whether they're correct or I'm correct. I guess the actors are saying, look, we're being safe, and that's the main part of a pension scheme. But my observation still comes back to the notion that an appropriate bond allocation is your age minus 50, i.e. if you're 55, your bond allocation should be around about 5%. And I guess that means that the vast majority of pension fund is still in equities with some alternatives, gold, infrastructure, and various other sort of asset classes that are available out there, maybe alternative things you can mix in. As you know, myself, I'm a little under the age of 50. My current broad asset allocation is circa 90% in equities and circa 10% in gold facing assets. Is that wise? We've debated this before, and I've talked about this on previous podcasts. I think it's appropriate for not just my age profile, but how I'm seeing the world at this moment in time, and even more importantly, going forward. And clearly, that combination of getting macro and micro sector stock insights and related may change. And I guess this is the reason for kind of thinking about this is because I was actually thinking about next month's podcast already, unbelievably. And when I say next month, I mean actually at the weekend, the 1st and 2nd of July, there's actually an important podcast coming because we're at that point where, yes, we can review how was the first half of 2023, how's it moved and shifted from both a macro and a micro stock sector perspective, and also throw in a few thoughts about how I perceive the second half of the year will also be moving. And I thought as a kind of a preamble towards all of that, I'd just kind of have another quick discussion about the importance of thinking about what's relevant for your own pension scheme. It does depend a little bit, not just on your own hard work and hopefully and sort of hard-working insights and accepting that you make mistakes and all of that sort of stuff, but also what's relevant for you, which is driven a little bit by age and related factors. But anyway, more on kind of the next sort of what's happening in the world, both in what has happened in the first half of the year and what's hopefully may or may not happen in the second half of the year, and ultimately too in slightly later in July, the start of the next corporate earnings season and what all that may mean in upcoming weeks. But anyway, a few further thoughts about what I regard anyway as an important matter concerning how to become a smarter investor. You know, life is always a learning process, and that's, to me, how you should always be thinking about many things, but as we're specifically talking about investments, the investment world and related. And frankly, it doesn't matter whether you've spent your life in institutional investing or not. You've got to keep on working hard. If you're not working hard, then guess what? Results start to show it. I'm afraid that's the way the cookie crumbles over the medium term. Anyway, this time, less about sort of the macro central bank ramble, a little bit more about the kind of the philosophy. Look out for the next podcast over the weekend on matters concerning how the first half of the year has shifted in the world and in the stock sector arena, and how it may or may not shift from my perception in the second half of the year. I look forward to sharing that with you in a few days' time. But for the meantime, thank you very much. Thanks for listening, and goodbye.